We shall commence this module by studying about the fair value accounting. Meaning of fair value. In common parlance, fair market value is the price at which the belongings will change hands between a eager buyer and a willing seller, neither being under any compulsion to buy or sell and both having realistic knowledge of the relevant facts. In accounting and economics, fair value is a rational and impartial estimate of the potential market price of a good, service or asset. It takes into account such independent factors such as acquisition, production, distribution cost, additional cost or cost of close substitutes. Fair value can also be defined as the price that two parties are willing to pay for an asset or liability, preferably in an active market. A less accurate measure of fair value is when there is an active market for a similar item, while the least accurate measurement method is to use the discounted cash flows associated with the future performance of an item. In accounting and economics, fair value is a rational and unbiased estimate of the potential market price of a good, service or asset. It takes into account objective factors such as: first, acquisition, production, distribution cost, replacement cost or cost of close substitutes. Second, actual utility at a given level of development of social productive capability. Third, supply versus demand. Subjective factors such as: first, risk characteristics, second, cost of and return on capital, third, individually perceived utility. Some fair value definitions. First, fair value is defined in ASC 820 as the price that will be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. Second, fair value of an orderly transaction is a hypothetical transaction assumed to take place on the measurement date with the subject asset having been exposed to the market for the usual and customary period of time for transactions involving such assets in order to provide sufficient time for marketing activities. Third, an orderly transaction is not a sale where the seller is under duress, for instance in a forced liquidation or distress sale. Fair value measurements are considered from the perspective of a market participant that already holds the asset or owes the liability. Fourth, the objective of measuring fair value is to determine an exit price, the price that will be received to sell an asset or the price that would be paid to transfer the liability. After studying this module, you shall be able to know the meaning of the term fair value, understand the relevance of fair value accounting, identify various steps for calculating fair value, evaluate fair value under IFRS, know fair value measurement by FASB or SFAS. Learn the three-level framework for estimating fair value. Understand the application of fair value in GAAP. Now let us discuss about the relevance of fair value, advantages and disadvantages of fair value in financial statements. It is a truth in accounting that for a financial statement or any accounting data to be useful, the two most important characteristics have to be relevance and reliability. Taking these two features from not only an internal view but also from an external viewpoint of a potential investor or a financial institution, some merits and demerits can be outlined. Advantages. Fair value has several advantages which have been recognized by all accounting bodies. Some of the advantages are being discussed include timely or relevant information, more information than historical cost, increased transparency, more reliable information and calculation of real worth of assets as on the date. Next, timely relevant information. Since fair value accounting utilizes information specific for the time and current market conditions, it attempts to provide the most relevant estimates possible. It has a great informative value for a firm itself and encourages prompt corrective actions. Second, possibility of more information in the financial statements than historical cost. Fair value accounting enhances the informative power of a financial statement as opposed to the other accounting method, the historical cost. Fair value accounting requires a firm to disclose extensive information about the methodology used, the assumption made, risk exposure, related sensitivities, and other issues that result in a thorough financial statement. Inclusion of more information is possible whenever there are a. Observable market prices that managers cannot materially influence due to less than perfect market liquidity. B. Independently observable accurate estimates of liquid market prices. Third, increased transparency. Such produced financial statements therefore increase transparency of a firm, which is particularly useful to potential investors, contractors and lenders as they have a better perception of the stability of a given firm and insight into its wealth. Fourth, reliable information. For a financial data to be reliable, they ought to be verifiable and neutral. Fair value provides that reliable information. Fifth, provides real worth of assets. In this dynamic and volatile market, people desire to know the real worth of an asset as on that date. Sixth, as per Financial Accounting Standards Board, fair value is the most relevant measure for financial investments. Seventh, avoidance of losses during recession. Fair value can help investors in avoiding losses during the recession period in any country. Next, disadvantages. However good a concept may be, but no concept is completely devoid of limitations. The fair value concept also suffers from some disadvantages that include price deviation, manipulations, absence of market price and problem of volatility, which have been discussed. First, pricing deviation. One of the most often quoted disadvantages of fair value accounting is the vagueness of the measurement procedure of assets for financial statements, which creates loopholes for pricing deviations. Second, manipulation. Manipulation of the price by the firms themselves also presents a risk in obtaining a fair value estimates because in illiquid markets, trading by firms can have an effect on both traded and quoted prices. Third, in case of absence of a market price. If a market price for a given asset is not available in the active market, fair value estimate that is supposed to provide the most reliable information is more difficult to obtain. Fourth, limited reliability. The information available in the financial statements provided by the fair value accounting method is relevant and reliable only for a limited period, as the information included in the statements is time specific for given market conditions. A change in the market environment could cause a major difference in the actual financial situation of a firm. Fifth, problem of volatility. It is closely related to previous issue of limited reliability. If the fair value of an asset follows the development of a market environment, this means that the value of an asset changes with the market. If the market with regards to the nature of a given asset booms, the price of a given asset goes up. If it busts, the price goes down too. A volatility of the market, which is an existing possibility, therefore creates a superfluous risk and could adversely affect the investment capacity of a firm. Next, steps to calculate fair value. Under mentioned are some steps which can be used for calculating the fair value. First, identify the item to be valued and the unit of account. Second, Determine the principal or most advantageous market and the relevant market participants. Third, select the valuation premise to be used for asset measurements. Fourth, consider the risk assumptions applicable to liability measurements. Fifth, identify available inputs. Sixth, select the appropriate valuation techniques. Seventh, make the measurement. Eighth, determine amounts to be recognized and information to be disclosed. Moving on to the fair value under IFRS. Valuation under IFRS IAS. In the past, company balance sheet have shown asset and liabilities values as per their original price. But from April 2011, this practice changed. As per the fair value practices outlined by the IFRS, assets and liabilities have to be valued at their current market value. There could be intangibles like brands, trademarks and customer relations which will now show up in the balance sheet of the acquirer. Fair value is the amount for which an asset could be exchanged or a liability settled between knowledgeable willing parties in an arm's length transaction. With IFRS all set to come to India, emphasis will be more on fair value accounting than cost-based accounting. Some of the standards where there will be need of fair valuation opinions are: first, share-based payment IFRS 2, second, business combination IFRS 3, third, financial instruments presentation IAS 32 and IFRS 7, fourth, impairment of assets IAS 36, fifth, property, plant and equipment IAS 16, sixth, employee benefits IAS 19, seventh, financial instruments measurement IAS 39, eighth, investment properties IAS 40, ninth, agriculture IAS 41. Next, fair value measurements by FASB. The Financial Accounting Standards Board FASB issued Statement of Financial Accounting Standards number 157, Fair Value Measurements, in September 2006 to provide guidance about how entities should determine fair value estimations for financial reporting purposes. FAS 157 broadly applies to financial and non-financial assets and liabilities measured at fair value under other authoritative accounting pronouncements. However, application to non-financial assets and liabilities was deferred until 2009. Absence of one single consistent framework for applying fair value measurements and developing a reliable estimate of a fair value in the absence of quoted prices has created inconsistencies and incomparability. The goal of this framework is to eliminate the inconsistencies between balance sheet historical cost numbers and income statement fair value numbers. Subsequently, FAS 157 was subsumed into FASB Accounting Standards Codification Topic 820 Fair Value Measurement, which now defines fair value as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. This is sometimes referred to as exit value. In the futures market, fair value is the equilibrium price for a futures contract. This is equal to the spot price after taking into account compounded interest and dividends lost because the investor owns the futures contract rather than the physical stocks over a certain period of time. On the other side of the balance sheet, the fair value of a liability is the amount at which that liability could be incurred or settled in a current transaction. Next is the three-level framework for estimating fair value. The framework uses three-level fair value hierarchy to reflect the level of judgment involved in estimating fair values. The hierarchy is broken down into three levels. First, level 1. The preferred inputs to valuation efforts are quoted prices in active markets for identical assets or liabilities. with the caveat that the reporting entity must have access to that market. Information at this level is based on direct observations of transactions involving the identical assets or liabilities being valued, not assumptions, and thus offers superior reliability. To use this level, the entity must have access to an active market for the item being valued. In many circumstances, quoted market prices are unavailable. If a quoted market price is not available, preparers should make an estimate of fair value using the best information available in the circumstances. The resulting fair value estimate would then be classified in level 2 or level 3. Second, level 2. Assets and liabilities are relatively uncommon, and even when they do exist, they may be too thin to provide reliable information. To deal with this shortage of direct data, the board provided a second level of inputs that can be applied in 3 situations. The first involves less active markets for identical assets and liabilities. This category is ranked lower because the market consensus about value may not be strong. The second arises when the owned asset and owed liabilities are similar to but not the same as those traded in a market. In this case, the reporting company has to make some assumptions about what the fair value of the reported items might be in a market. The third situation exists when no active or less active market exists for similar assets and liabilities, but some observable market data is sufficiently applicable to the reported items to allow the fair values to be estimated. Third, level 3. The FASB describes level 3 inputs as unobservable. If inputs from level 1 and level 2 are not available, FASB acknowledges that fair value measures of many assets and liabilities are less precise. Within this level, fair value is also estimated using a valuation technique such as discounting factor. However, significant assumptions or inputs used in the valuation technique are based upon inputs that are not observable in the market and therefore necessitates the use of internal information. This category allows for situations in which there is little, if any, market activity for the asset or liability at the measurement date. FASB explains that observable inputs are gathered from sources other than the reporting company and that they are expected to reflect assumptions made by market participants. The FASB, after extensive discussions, has concluded that fair value is the most relevant measure for financial instruments. In its deliberations of Statement 133, the FASB revisited that issue and again renewed its commitment to eventually measuring all financial instruments at fair value. Let us now understand the application of fair value in GAAP. IFRS 13 fair value measurement was adopted by the International Accounting Standards Board on May 12, 2011. IFRS 13 provides guidance for how to perform fair value measurement under IFRS and took effect on January 1, 2013. It does not provide guidance as to when fair value should be used. The guidance is similar to the US GAAP guidance. ASC Fair Value Topic ASC 805-20-30 Business Combinations, Identifiable Assets and Liabilities. AFC 815-10-50 Derivatives and Hedging Disclosures. ASC 820 Fair Value Measurements and Disclosure. ASC 825-10-25 Financial Instruments, the Fair Value Option. ASC 350 Goodwill Impairment. ASC 360 Other Long-Lived Asset Impairment. ASC 718 Share-Based Compensation. GAAP setting bodies. Currently, there are nearly identical fair value measurement and disclosure provisions. Given are the names of the bodies which are responsible for setting generally accepted accounting principles for bringing about uniformity in reporting standards. The Financial Accounting Standards Board sets US Generally Accepted Accounting Principles GAAP. The International Accounting Standards Board sets International Financial Reporting Standards. IFRS are adopted in 110 countries in Europe, Africa, Asia, South America and North America except US. The FASB and IASB are working toward GAAP conversions. For the last several years, all GAAP changes have been approved by both organizations. Let us now recapitulate what we have learned so far. Fair value is defined in ASC 820 as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. The objective of measuring fair value is to determine an exit price, the price that would be received to sell an asset or the price that would be paid to transfer the liability. Fair value has several advantages which have been recognized by all accounting bodies. Some of the advantages include timely or relevant information, more information than historical cost, increased transparency, more reliable information and calculation of real worth of assets as on the date. However good a concept may be, but no concept is completely devoid of limitations. The fair value concept also suffers from some disadvantages that include price deviation, manipulations, absence of market price and problem of volatility. IFRS 13 fair value measurement was adopted by the International Accounting Standards Board on May 12, 2011. IFRS 13 provides guidance for how to perform fair value measurement under IFRS and took effect on January 1, 2013. It does not provide guidance as to when fair value should be used. The guidance is similar to the US GAAP guidance. Currently, there are nearly identical fair value measurement and disclosure provisions. Thank you.